What's going on, you guys? So in this series of videos, we're going to talk about everything that you need to know about stocks and the stock market. Stocks are an absolutely crucial part of building wealth and is something that everyone has to understand. I'm going to break this subject down so that even a 10-year-old can understand everything. If you're having trouble understanding what a stock is and how stocks work, this video is going to be for you. By the time this video series is done, you will have a complete understanding of the stock market. Let's not waste any time and get right into it. Alright guys, so first let's talk about what exactly a stock is. We will have two examples in this video. First, we will be doing a real estate example, and then we will do a business example. So a stock is a part ownership of a company. Let's break down exactly what that means. Let's begin with the real estate example. Let's say you and 9 other friends want to start a business. The business is going to be real estate. So you and your 9 friends are going to buy a house. Let's say the house costs $500,000. So there's going to be 10 people total, and each person is going to bring $50,000 of their own dollars. The first thing that we will have to do is open a corporation. A corporation is a legal entity that can do everything that a person can. It can have its own social security number called an EIN, it can have a bank account, it can have credit history, it can buy property, and it can also go bankrupt if it's not run correctly. A corporation can have one owner or it can have millions of owners. So what you guys are going to do is incorporate a company. To do this, you will have to fill out a document called the Articles of Incorporation. This document will have info such as the company's name, its address, and how many owners it has. And you're going to open up a business bank account for this company. Each one of you will deposit $50,000 of their own dollars into this bank account, and you will all own the equal part or share of this company. So the total amount of money in the bank account is $500,000. Each person brought $50,000, so each person owns 10% of that company. In the Articles of Incorporation, you will state how many outstanding shares this company will have. This is how many part owners or shareholders this company has. So since we're buying a house, which is a very simple business, we're buying the house to make rental income, there are 10 investors or shareholders, so we will have 10 outstanding shares. Each shareholder is going to own 10% of the company. That ownership is called equity. The words stock, share, equity, and ownership all mean the exact same thing. They are all synonymous. So this company has 10 total stocks or shares, and each person's equity is $50,000. So each share or each stock is worth $50,000. Let's talk about what exactly equity means. To understand equity, we must first understand the difference between an asset and the liability, the two most important words in the finance and the business world. An asset is simply something that is worth money and brings in money. A liability is something that takes money away. An example of an asset is a business that is profitable, a factory that can produce a product, inventory that can be sold, a building that can be rented out for monthly income, or cash that can be used to grow a business. An example of a liability is a debt that has to be paid monthly, which takes money out of the company. Another example is stuff like fancy furniture for an office that becomes worthless over time and does not bring any money. Equity simply means how much assets you have in cash after you subtract all liabilities. So assets minus liabilities equals equity. Alright guys, now let's go back to our house example. So me and 9 other friends bought this house. So now how are we going to decide who runs and controls this house? For example, say if we have a tenant and something breaks, there's a plumbing issue. Who's going to come out and deal with all of this? Well, when you open a corporation, you're required to list a board of directors. A board of directors is simply a small group of people who run the company. Large established companies require a team of people to run it and to grow it. People such as the CEO, who makes all executive decisions, a CFO, who's the chief finance officer, who's responsible for all accounting and finance, and the COO, who's the chief operating officer, which is the person that's under the CEO and manages everything. If you're a small company, you can be the one person that does all of these, by the way. Now, the way these positions are established is through voting. Every shareholder has voting rights. So in our case, there are 10 shareholders, and each shareholder has one voting right. Every shareholder votes for the person that they want to put in that position. The person who gets the majority of the votes gets the position. Now, for our house example, we won't need a whole board of directors, but we will still have to select 1 or 2 people to run everything and deal with things such as tenant issues. Most of the time, investors or shareholders are already busy enough with their own lives, so they don't want to deal with the everyday task of being a part owner of a house. They just simply want to get their share of the monthly income part and wait for the house to increase in value. So really quick, let's do a recap of everything that's happened so far. So me and 9 other friends started a real estate business. We went on LegalZoom.com and incorporated the business. Let's say we call it ABC Real Estate. In the Articles of Incorporation, we put that ABC Real Estate has 10 shares outstanding. We each put down $50,000 and bought a house for $500,000. Now, since there are 10 shares outstanding, each share is worth $50,000. Each one of us owns 10% of the company. We all came together and decided on who we want to run and manage the business. Since some of us are too busy to be involved in managing real estate, we chose one of our shareholders who already had experience with real estate to run the business day by day. Now, of course, managing one house does not require a lot of work, but whenever the tenant has some kind of issue or needs a repair done, he knows which one of us to call to get things fixed. Since this person already has a lot of experience doing real estate, we trust that he knows what he's doing. All of us can come together and vote on whether or not we should pay this person a couple $100s extra a month, but since he's already an investor, let's just say he will not be paid. So all 10 of us will come together and decide what our goal for this investment is, and we all decide that our goal for this investment is to get rental income and in time let the property appreciate in value. In other words, letting our stock appreciate in time. So this house costs us $500,000 to buy, and every month we're going to get $4,000 in rental income. We're going to split this rental income into 10 parts, and each shareholder will make $400 a month. This is called a dividend payment. When a business makes money and distributes that money to shareholders, that's called a dividend. Now, let's say that the person that we trust to manage the property, let's call him our CEO, decides that the first 2 months, he will not distribute a dividend because he wants to save $8,000 in case something in the house breaks to have a cash reserve. So let's say 2 months later, the value of the house did not change. Each one of us still has $50,000 in equity, but now we also have $8,000 cash in the company's bank account. So how much is our stock worth right now? Again, so our stock is the equity, and equity is assets minus liabilities. So we only have assets right now. We do not have any liabilities. So our equity is the original $50,000 that we all put up. So $500,000 plus $8,000 cash. So now our company is worth $508,000. If we divide that into 10 parts, that means that each share is now worth $50,800. If our CEO decides to pay the $8,000 out as a dividend, that means the equity of the business is $500,000, which means each stock is worth $50K again. Now, let's say our CEO makes a bunch of mistakes and continuously mismanages the property. We can all come together and vote him out and change CEOs. Even if he gets voted out, he still owns 1 share of stock. He's still entitled to his 10%. So every time the company pays out a dividend, he's still going to get paid his $400. Now, let's say 5 years down the line, the house appreciated in value and is now worth $600,000. That means that each of our stocks is now worth $60,000, and we still get a dividend payment of $400 a month. Now, let's say something happened in the economy and the housing market crashed and prices went down. If our house costs $400,000, that means each one of our stocks is worth $40,000. Even if the price of the house went down, we're still getting rental income of $4,000 a month. That means we're still getting a $400 dividend each month. Let's say 10 years go by and the house is now worth $700,000. And we also increase the rents to $5,000 a month. That means our stock is worth $70,000 each. And we get a dividend of $500 a month. Alright guys, now let's do another example. This time, let's do a house with a mortgage. So again, we have 10 people. We're all going to buy this house that costs $500,000, but this time we all don't have $50,000 to put down. So we're going to get a mortgage or a loan from the bank, and the bank will require us to put down 20% of how much the house cost. So 20% of $500,000 is $100,000, and if we split that 10 ways, that's $10,000 each. So now let's break down the numbers. This time we have a liability, which is our debt, of $400,000. Our equity is $100,000 divided by 10 people. So each stock is worth $10,000. So as an example, let's say our monthly payment for this house is $2,500. That includes the principal and interest payment, tax, insurance, HOA fees, and everything else. Let's say we rent this house out for $3,000 a month, so our cash flow is $500 a month every month. If we divide that $500 by 10 shareholders, that means we each get paid $50 a month. That's going to be our dividend payment. Now, real quick, I want to break down how a mortgage payment works. So when you guys get a mortgage, your monthly payment to the bank is going to consist of 2 things, the principal amount and the interest amount. At the beginning of the loan, the majority of the payment is going to go towards interest. The bank is going to get their money first. But as time goes on, the principal payment will increase. The principal amount is the amount that's paying off the loan, and is the amount that goes towards equity. So let's say your loan just started, you guys each have $10,000 in equity, and each month you get a cash flow of $50. So there are 10 outstanding shares right now, and each share is worth $10,000. Now, let's say 10 years go by, it's the year 2032, you've paid off around $100,000 of your principal payment, and your debt is now $300,000. So how much is your stock worth now? Let's say the house price didn't change, it's still worth $500,000. Your debt is $300,000, so that means you have $200,000 in equity. So each one of your shares is worth $20,000. Now, in 30 years after this loan is paid off, how much is your stock going to be worth? Obviously, the price of the property and the rental amounts will increase, but let's just say for this example, they don't. So let's say you paid off the entire debt, the house is fully paid off, it's worth $500,000, and each one of you owns 10%. So how much is your stock worth? So 30 years later, each one of your stocks is now worth $50,000. Alright guys, now let's use a business example. So let's say one night, you and 4 of your friends are sitting around and you decide you will open up a sneaker store. So you guys will incorporate a company. You're going to open up a bank account for this company. All 5 of you will be on the board of directors. There's going to be 5 investors total. Each one of you will own 20% of the company. So let's say you guys will need around $100,000 to start this business. Each one of you will have to provide $20,000 of equity. We will need to buy a bunch of sneakers to resell, and we're also going to need cash to build our store and for other things such as marketing. So let's say that all of my friends have $20,000 cash to put down, so that's $80,000, but I don't have $20,000 cash. But I do have something that is worth $20,000. I have $20,000 worth of sneakers in my collection. So I'm going to put down my sneaker collection, which is worth $20,000, and I will have 20% of the company. Remember, inventory for a business is still an asset. So now the total equity that we have is $100,000. So we now have $80,000 in cash and $20,000 in sneakers. The next step is to find a store to rent out. So we're going to find a store, and the store is going to cost us $5,000 a month. It's going to cost us $5,000 to build out the store, and we're also going to spend $5,000 on marketing. So we're going to buy and resell sneakers, and all the money that we make, we're going to reinvest it back into inventory. So we're going to buy more sneakers with all of our profits. At the end of the year, we're going to look at our balance sheet and look at how much money we've made. A balance sheet is a financial statement that shows the company's assets and liabilities and also the shareholders' equity. I will do a more in-depth video on balance sheets later on. So let's say we had a good year, and at the end of the year, we have $200,000 worth of sneakers in our inventory and $50,000 worth of cash. But we were also paying $5,000 a month to lease the store, so that's $60,000 a year. We spent $5,000 to build the store, and we spent $5,000 for marketing. Let's say we had an interest-free credit card for a year, and we decided to put all the rent payments, the cost it took to build the store, and the marketing fees on this credit card. It made sense to do this because we could take all that money and reinvest it back into sneakers to help us grow faster. Let's say we did not take any profits out of the store and we lived off of our savings. So in other words, we did not pay ourselves a dividend. Instead, we reinvested everything back into the business. So at the end of the year, we have $250,000 worth of assets and we have $70,000 worth of liabilities. The $70,000 liability is our credit card debt. So how much is each of our shares worth right now? So our equity is $180,000. Each one of us owns 20% of the company. So each person's stock is worth $36,000. Alright guys, so for this business, when we filled out the articles of incorporation, we only listed that there will be 5 outstanding shares. So each one of us would own 20% of the company. When you incorporate a company, you can make as many outstanding shares as you want. So instead of 5 shares outstanding, we could have made 50 shares outstanding and each one of us would own 10 shares. Each of our equity amounts will still be the same. When we started out, instead of each share being worth $20,000, instead we could have each had 10 shares and each share will be worth $2,000. Our equity would still be the same. Instead of having one share that's worth $20,000, we would simply have 10 shares and each one of them will be worth $2,000. Or we could have issued 500 shares and each share will be worth $200. So if each of us would own 100 shares, each share will be worth $200, which still equals $20,000. Regardless of how many shares you issue, the equity remains the same. We will talk about why certain companies choose to offer hundreds of thousands or even millions of shares for the companies later in the series of videos. In the next video, we will talk more in depth about shares and the different types of shares there are.